Hello students, today we are going to discuss a very important topic, that is transfer pricing. So as the name suggests, transfer pricing, it means in this topic we are going to study what is the meaning of transfer pricing and what are the various methods by which we can evaluate, or you can say by which we can calculate the various transfer prices. So first of all, we need to understand what does the word transfer pricing means. Transfer pricing refers to the pricing policies which are used within the organization. Whenever the goods and services are to be transferred from one department to another, there is need of separate accounting. The goods which are transferred from one department to another are needed to be recorded on the books of accounts. The price at which these goods are charged to the other department are known as transfer pricing. So, when internal exchange of goods and services take place between the different departments, then they have to be expressed the transaction in monetary form. Such monetary form is known as transfer pricing. So, you can say that transfer price is the price at which divisions of a company transact with each other. Transfer prices are used when the individual entities of a large multi-entry firms are treated and measured as separate run entities. So, if we go, what is the definition of transfer pricing? It is transfer pricing is setting of the price for goods and services sold between related legal entities within an enterprise. So the next topic is objectives of transfer pricing. As we all know, whenever we are going with any concept, there are certain objectives in our mind which is keeping in mind we go with our subject, or you can say with our concept. So what are the various objectives behind transfer pricing? First objective is goal congruence. Goal congruence means there should be uniformity of the goals. The prices should be set so that the divisional management desire to maximize divisional earnings is consistent with the objectives of the company as a whole. So it means that transfer price should be set in which the goals of the various departments should be congruented with the goal of the concern. The next objective is performance appraisal. The prices should enable the reliable assessments to be made for the divisional performance. The transfer pricing helps us in guiding decision making. It also helps in appraising managerial performances. The next objective is divisional autonomy. So, divisional autonomy means the prices should seek to maintain the maximum divisional autonomy so that the benefits of decentralization can be maintained. The profits of one division should not be dependent on the actions of other divisions. The next main objective of transfer pricing is simple and easy. At present, many concerns opt for transfer pricing because of this very reason. The system should be simple to understand and easy to administer. The most important objective is relevant information. The transfer price should provide each segment with the relative information required to determine the optimum trade-off between the company cost and its revenue. Now, the next topic that we are going to study is the methods of transfer pricing. As we have studied that what is the meaning of transfer pricing and what are its various objectives. So now the main topic comes, what are the various methods which help in evaluating, or you can say it helps in estimating the transfer price. These are few methods which I have illustrated in this slide. Now we will discuss each one by one. So the first method, or you can say the various transfer pricing methods, in with this, the first method that we are going to study is market rate transfer pricing. When a market exists outside the firm for the intermediate product and the firm is a price taker, then the use of this method, that is market price as a transfer price between the divisions, will generally lead to optimal decision making. This is the most simplest and most elegant transfer price to be used in case of the market price. By doing this method, the upstream subsidiary can sell either internally or externally and can earn the same profit with either options. The next method is adjusted market rate transfer pricing. In this, if the market is not possible, or you can say it is not possible to use the market based pricing technique which we studied earlier, then its method, that is the adjusted market rate transfer pricing, is taken into consideration. Then the next method is negotiated transfer pricing. Negotiated transfer pricing, this it may be necessary to negotiate a transfer price between the subsidiaries without using any market price as a baseline. So transfer price could be set by negotiation between the buying and the selling division. This situation arises when there is no discrimination market price available, because the market is either very small or the goods which we are going to deal, they are highly customized. The next method, that is your contribution margin transfer pricing. If there is no market price at all from which we can derive a transfer price, then an alternative is to create a market price based upon the components of the contribution margin. As we all know, in case this method is opted where we can calculate the contribution margin, that what will be the difference that the concern can earn, that is the distinction between, or you can say the difference between the sales and the variable cost. So in this method, the transfer price is estimated on the basis of contribution margin. The next method, that is your cost plus transfer price. In this method, as the name suggests, the transfer price will be based upon the cost of the product that is to be transacted between the various divisions of the organization, or you can say the product which is to be transferred from one division to another. The transfer price will be based upon the cost of that product. In this method, the transfers are made at the full cost plus a profit markup. The full cost is likely to be treated by the buying division as an input variable cost, so that the external selling price divisions, if based on the cost, may not be set at levels which are optimal as far as the firm as a whole is concerned. Thus, in this method, the buying division is charged the actual unit cost of production of the transferring department plus a markup for the profit. So we can say that cost plus transfer pricing method is used if there is no market price available at all on which to base a transfer price. The best way to do this is to add a margin onto the cost, where you compile the standard cost of a component, add a standard profit margin, and the result that will be getting, it is known as your transfer pricing. But there are certain limitations when we are using this cost plus transfer pricing. The first and the most, you can say, important limitation to this easy method is that is the calculated cost is only accurate at one level of the output. If the concerns are able to calculate the cost accurately, then they will be able to put the transfer price easily. So the next is the validity of any transfer pricing based upon the past cost is questionable. So the next method that we are going to discuss is cost based transfer pricing. So cost based transfer pricing system are commonly used because the conditions for setting ideal market prices frequently do not exist. For example, there may be no intermediate market, or the market which does exist may be imperfect. Providing that the required information is available, a decision rule that would lead to the optimal decisions for the firm as a whole would be to transfer at marginal cost up to the point of transfer plus an opportunity cost to the firm as a whole. So we can say that you can have each subsidiary transfer its product to the other subsidiaries at a cost, after which successive subsidiaries add their cost to the product. This means that the final subsidiary that sells the completed goods to the third party will recognize the entire profit associated with the product. So this is one of the major drawbacks of this cost-based transfer pricing, because the efforts that was done by the selling subsidiary, they are not able to earn any profit because the goods are transferred from the selling subsidiary to the buying subsidiary at a basic cost. As we discussed in the previous method, that was cost plus markup. In that, the concern was selling the goods to the other concern at a certain markup, or you can say at a certain margin. But in this method, the goods are purely transferred from one subsidiary, or you can say from one entity to the another entity, totally at a pure standard cost. There is no markup, or you can say no margin added to the transfer pricing. So these were the few methods by which we can evaluate the transfer pricing. Now the next and the, you can say, the present context that is used, that is the multinational transfer pricing. In addition to goal congruence and motivation, transfer pricing in multinational companies is dominated by the factors like minimizing income tax, import duties, tariffs. Such companies may also try to manipulate transfer pricing consciously as an instrument of maximizing its achievement of corporate goals. International or interstate transfer pricing can affect tax liabilities, royalties, and other payments due to different laws in different countries. So, multinational transfer pricing is a method that is used where the concerns, or you can say the subsidiaries within which the goods are to be transferred, are located in different geographical regions, or you can say at the different regimes where the tax liabilities of the both the subsidiaries locations is different. In that condition, we use the multinational transfer pricing. So in this video, students, we discussed what is the meaning of transfer pricing, what are the various objectives behind this concept, and what are the various methods which can be used to calculate the transfer pricing. Based upon the situation and based upon the information available, we can use any of the method available. So I hope this topic of transfer pricing is clear. Thank you, students.